This is the first book on finance I read when I started my career, and I would agree with Warren. It is an incredible book, full of a lot of brilliant principles. So I actually we did receive a an email request from one of our listeners about doing more content about the books that we read and some of the big ideas that we get out of those books. So right when I saw that, the first book obviously that came into my mind was The Intelligent Investor, which is, I would say, one of the great classics of investing. So if you are a stock investor, that's a book you're going to want to read. But why don't we just get into the presentation here, and I can talk about what I think are some of the most important ideas of this book. So, as we were just discussing on the podcast, Ryan is great at stealing people's content before we have a chance to talk about it ourselves. I'm joking. Um, but it is true. Ryan mentioned that Warren Buffett has given a very strong review of this book. Benjamin Graham, who was the author of this book, a legend in the field of investing, is actually one of the big mentors of Warren Buffett. He was a professor when Warren Buffett was studying finance in university. Warren Buffett also, I believe, worked for Benjamin Graham for a period of time as well. And he says that The Intelligent Investor was by far the best book on investing ever written. So if Warren Buffett is going to give an endorsement like that to any piece of information, I think that any stock investor would be definitely recommended to invest the amount of time needed to read that book and learn some of the principles, just based on Warren's endorsement alone. But we also endorse this book. I believe, Ryan, you've read it as well. And as I said, it's really a book that kind of opened my eyes to how stock investing worked, beyond what you would necessarily read in like an investing 101 textbook or what I would learn in school. More about like the practical application of investing. And this book was written, I believe, back in the early 1930s. I'll have to check that, but around that time. So a lot of the things that Benjamin Graham talks about, you can tell, are a little bit dated, but the general principles still hold true today. And so what do I believe are the top 5 ideas from the book? There are many great ideas and things to learn from this book, but the 5 I'm going to focus on are the difference between investment and speculation, the concept of value investing and margin of safety, the importance of fundamental analysis, avoiding market timing strategies, and then also the importance of emotional discipline. So let's start with investment versus speculation. What is investment? Investment is when you commit capital to something based on thorough analysis, and you're focused on both safety of principal and adequate returns on your capital relative to the risk that you're taking. And all of this is based on an analysis of the actual fundamentals and financials of whatever it is you're investing in. Speculation is engaging in risky transactions aiming for a quick profit. You're not really basing your investment outcomes or potential investment outcomes on analysis. You're just basing it on a hope. So there is absolutely nothing wrong with going to Las Vegas and saying, I've got $200. I'm just going to gamble and see what happens. But it is definitely problematic if you consider that investing. And unfortunately, too many people in the market don't really differentiate between investment and speculation. So distinguishing between the two really helps you to avoid unnecessary risks and promote your long-term financial success. So when you understand that you're speculating in something, same with my example of going to Las Vegas, this is about fun. This is about, I could make money. Likely I will not, but I have a certain amount that I'm willing to lose, and I'll just throw that in for fun. And then maybe I'll be lucky and actually come out with a good outcome. As long as you enter into stock speculations with that mindset, then there's nothing wrong with speculation. The problem is when people enter into stock speculations, confusing them with investing and actually thinking that they're investing. So practical application of this idea. Focus on investments that are backed by solid fundamentals rather than just chasing trends or hot tips. If you don't know anything about the fundamentals, when I say fundamentals, I mean the actual business, like the product, the service, the revenues, the earnings that are generated, what the balance sheet looks like. Is there too much debt? If you don't know anything about the fundamentals, then you are, almost certainly speculating, even if it is not a speculation. So if you're just understanding the trend, if you're just hoping that the investment is going to work out well, and you're making a bunch of assumptions, then that's a speculation. So you never want to speculate with money that you can't afford to lose. Now, investing in established companies has proven to be the best strategy in terms of risk adjusted reward for investors over time. And a lot of people think that to get the big returns, you have to speculate. That is absolutely not true. Just look at a couple examples from our research, from Microsoft, to Boyd, to Hammond. Solid, profitable businesses, real companies that produced returns well above, any of the speculations that we've seen that have actually worked out well. So investment versus speculation, very important to understand the difference. Number two, value investing and margin of safety. So what Benjamin Graham is talking about here is buying securities or buying stocks or any type of investment below their intrinsic value. And this provides a margin of safety. So if you're buying it below the intrinsic value, then you can afford to make somewhat of a mistake in terms of assessing what the intrinsic value is. And you'd still be making a value investment. So this protects against errors. It protects more against market downturns. It just gives you some safety. Why this matters: margin of safety will reduce your risk, and you're also always looking to invest with the lowest amount of risk for whatever return expectation you have. So it's not about investing is not about just chasing ideas that you think will produce potentially huge returns over time if everything works out. It's also about managing risk and focusing on risk adjusted returns. So practical application, really looking beyond just the story of the company and looking into the actual structure of the company in terms of, what is the business model? What are the products or services? This really comes down to fundamental analysis. And this is what's necessary to determine a stock's true worth. And you really only want to invest in that company, according to Benjamin Graham, if you're able to buy it at a significant discount. Examples from Warren Buffett's investments. One might be Coca-Cola. When he first purchased that company, I believe back in the 1980s, he ascertained that it was trading at a significant discount. And, really it only takes, I think Warren Buffett said that it was only about a dozen or so investments that have resulted in, 90% of his success. And this success has come from focusing on that margin of safety and value relative to the business. Now, importance of fundamental analysis, and I did talk about fundamental analysis in the value investing and margin of safety idea, but I wanted to just really drive that point home because it's something that most investors don't really think about when they're purchasing stocks. In a lot of cases, they don't have the expertise to really understand the fundamentals of a business, which is why a lot of people will utilize our research. But this is really a thorough analysis of the company's financial health and financial performance. And this is what is necessary to determine whether or not you're purchasing a company at a reasonable price and getting that margin of safety. So what you're doing when you're focusing on a company's fundamentals or financials that are actually available and reported, as opposed to just listening to what management is saying, or listening to what people on the internet are saying about a company, is you're grounding your investment decision in actual facts and data, as opposed to just emotional discussions and promotions. So what is it? The practical application of fundamental analysis. This is when you're evaluating the earnings, the revenue. You're also looking at, the company's products and services, what kind of competitive advantages they have. But really, it comes down to the way to validate those competitive advantages really comes down to the financials of the business. So the revenue, the earnings, and then also as well, what is the debt structure, and is the company overloaded with debt, and is that a risk, or does the company have excess cash on its balance sheet, which it can then go and invest in order to grow? One of the things when we are in speculative bubbles, that's when people are looking for the next hot thing. They're looking for trends. They're listening to promoters a lot more. They're getting a lot of their information on social media. Financial analysis really helps investors identify companies that are actually doing well, not just that are part of a trend, which people believe are going to do well. And a lot of times you will find those fundamentally strong companies are actually part of these key trends. And those are the companies that we would want to focus on. And if that key trend, like say AI or technology innovation continues to be strong, then we would expect that to result in a continuation of growth in revenue and earnings per share for the company. Big idea number 4 is to avoid market timing strategies. So the key idea here, trying to predict the market highs and lows, is speculation by definition. For the vast majority of investors, it's going to be very unsuccessful over time. They may be successful on individual trades, but individual trades are not important. What's important is your aggregate return over time, long term. So long-term investing is just empirically a more reliable method of generating investment returns, and it also requires less of a time investment than would a market timing strategy. So avoiding market timing reduces the risk of missed time trades and potential losses. That is true, but as many traders will say, you can be right from time to time, but it is very difficult to be right all the time. Although you don't have to be right all the time, you have to be right enough to justify your market timing strategy. So what I tend to see a lot from especially retail investors that try and time the markets is they may be successful on getting out of the markets before they decline. A lot of times I've spoken to people that shortly after a market decline, they said, I was sensing a lot of risk in the market, and I decided to just exit all of my positions. And now I'm sitting on cash. I'm feeling really good about it. When the market is just pulled back, that investor looks incredibly intelligent. But the reality is that, more often than not, I will hear back from that person 6 or 9 months later. And this will be after the market has already recovered, bottomed out, recovered, and is gone to new highs. And they still haven't gotten back into the market because there is no clear sign for them to do so. When the market was going down, it always looked like it was going to continue to go down. And when the market started to bounce back up, there was that cognitive dissonance that comes from not getting it on the bottom. And then the thought that the market was going to turn around and come back down. So market timing for most people do not work. Stick with a disciplined investment plan focused on value rather than reacting to short-term market movements. And just as an example, investors who didn't try and time in and out of the markets in 2008, in 2020, in virtually any market correction or crash, saw their investments recover. Unlike many of those who sold in panic, they never got back in time for that recovery. And then number 5, just the importance of emotional discipline. So controlling your emotions like fear and greed is absolutely crucial to making rational investment decisions. It's crucial to making any type of decision in your life, as I'm sure nobody is going to argue. But this is something that we see a lot in investing. When the market is going up, people get greedy. They overpay for things. They speculate, thinking that's investing. And then when the market turns around and starts going down, when there actually are good opportunities, they're too afraid to actually pull the trigger. So this is very counterproductive to successful investing over time. Focusing on just being rational and emotional discipline, it prevents these impulsive reactions. So whenever you're going to make an investment decision, you can always just ask yourself, how do I feel right now? Is this decision being made based on rational analysis, or is it being made on emotion? A practical application is just establishing your investment criteria, your long-term goals, regardless of market fluctuations, and sticking to that. So at Keystone Financial, one of the things we've always said, a lot of people, depending on what happens in the markets, if the markets are going up and they're expensive, if the markets are coming down and people are fearful, they will ask us, well, how does the current market environment change your investing strategy? And the fact of the matter is, it really doesn't, because the strategy is to focus on purchasing profitable, growing companies with strong products and services in markets where they're solving problems or providing essential services. And these are the types of companies you want to own long term in any type of market. Now, if we're able to buy these assets at reasonable prices, then we buy. And if we're not able to, then we wait until those opportunities arise where those prices are reasonable. But that's not about watching the movement in the share price or not buying or selling because the market has gone up or the market has gone down. We always stick to that criteria, and that has helped us be successful for our clients through a variety of different market environments and crashes and booms and bubbles and recoveries over the last 25 plus years. So sticking to that criteria, no matter what. Nowadays, social media, constant news cycles, they trigger these emotional reactions, but having that disciplined strategy and always going back to that, and whenever you're making a decision, referring to that strategy is what is going to help you be successful in the market. So these are the five big ideas that were, or five of the big ideas that were discussed in the book, The Intelligent Investor. And there are many other great ideas as well. I'm sure some people would have wanted to hear a few others, but we have limited time. One thing I do want to say, though, before I open things up, is that the advice from Benjamin Graham, as I said, this is many decades old advice. This is, we're basically going back almost a century here. A lot of things have changed in the market. The high level principles that he's talking about have not, in terms of emotional discipline, focusing on the actual fundamentals of the business. All of those things are true, but some of the specific strategies, the specific tactics rather, that he employed back then would not be successful nowadays. So one was, just in terms of his value investing strategy, he wanted to buy things very cheap. He was looking for an absolutely massive margin of safety. For most businesses nowadays in the current environment, you're not, if you're looking for a margin of safety to that magnitude that Benjamin Graham was looking for back then, you're not going to be investing in any good companies. So Warren Buffett actually learned this the hard way. When he first started investing, he tried to deploy Benjamin Graham's advice basically verbatim, and he ended up not doing well. And that's when he decided, you want to know what? I need to look at the high level principles of what he's talking about, but I need to adapt those for my own investing in my current market environment. And one of the things he did is he said, you want to know what? I'm still a value investor. I'm still price sensitive, but I'm not looking for the cheapest companies. I would rather buy a great company at a reasonable price rather than a bad company at a great price. And from there, he started to perform better. That is GARP investing, growth at a reasonable price, which is more in line with what we do at Keystone. Okay, so I'll
Yeah, for sure. I mean, you always have to adapt, right? And I think that people who want to discard Graham's core principles are silly, because you can still use the core principles and adapt them to today's. Not adapt them so you're not using them, but adapt them so they better represent an investment strategy that you can use today. And again, that is largely the core to what we're trying to do for our clients on an annual basis.
Yeah, like one thing that really stuck out to me, like I've read The Intelligent Investor as well, and I've brought it up on the podcast before, but just I kind of want to read just like a little bit of a piece of it here, where again, Aaron like went over it, but it's avoid or not completely avoid, but be weary of investing in a trend that people think will do well for sure. And I brought it up before, but they bring up the airline industry. And Benjamin says here, such an investor may, for example, be a buyer of air transport stocks because he believes their future is even more brilliant than the trend the market already reflects. And he kind of says a warning here where, For this class of investor, the value of our book will lie more in its warnings against the pitfalls lurking in this favorable investment approach than in any positive technique that will help him along this path. And then they go on to say, or he goes on to say, the pitfalls have proved particularly dangerous in the industry we mentioned, airlines, he's talking about. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenue at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. And in the year 1970, despite a new high in airline traffic figures, that the airlines sustained a loss of some 200 million for their shareholders. So again, it's just the pitfalls of just, trying to find that next trend. That really stuck out to me. And I think that it is a great example, because if I was back in, 1940, 1950, and these airline stocks were coming out and I was a lay investor, I would have thought, we need to get it. How can you go wrong? But obviously it wasn't a great place to invest.
I mean, we saw something similar to that in cannabis, because,
Exactly.
the demand is there, the demand is there, demand, that's all we heard, and then everything will take care of itself. But if the demand is fed by an industry that is oversupplying that demand, even if the demand is great, you have an industry that isn't really a great investment. There was tons of revenue growth. There was not a great deal of profitability. Too many companies. I will watch the industry. There may be a point where it is, a viable industry, but it was a race to the bottom in terms of margins, a land grab, and it was a terrible, terrible place to invest for those reasons. Despite, yes, there was growth, there is demand, but that doesn't make for a good investment across the board, or even in individual companies in the sector.